The purpose of this video is to review three capital investment scenarios and their sensitivity analysis with respect to net present values, internal rates of returns, with me, Duncan Williamson, September 2025. Welcome to the video. The base case, as you can see there, for the three scenarios of expected, likely, worst case, and best case are that they all share the same initial cost of $40 million. Their expected annual cash flow, inflow, is $20,000 in each case. However, the discount rates, the cost of capital, are expected to be different. 10% expected, 12% for the worst case, 8% for the best case, and the project life of all projects is 3 years. In the expected case, for every row, we find the present values, PV, by multiplying the expected cash flows by the discount factors. And the NPV is the sum of the present values, the PV column. Since it's only the WACCs that are different for each scenario, the evaluation of all NPVs isn't difficult. Here, the expected NPV formula is B6, the rate, comma, F11 to F13, bracket plus F10. And similarly, for the worst, where the rate is in C6, and the best, where the rate is in D6. The IRRs are all the same in this scenario, in these scenarios, because all the cash flows are different, so the IRRs must be the same. You can work out what the formula for that might be. Let's develop things a little bit further now. So the discount rates are 10, 12, and 8% as before. The project period, 3, 3, 3 as before. The initial costs are still 40,000, but now the expected annual cash flows are different. The expected scenario, they're still 20,000 for each year. The worst case, they've dropped to 6,000 per year, and for the best case, they've increased to $34,000 per year. Let's see the impact of all of that. We'll evaluate this section in two parts, the NPVs and the IRRs, and then what do we mean by cash flow for NPV equals 0? We've already said that the cash flows are different by each scenario, and so are the WACCs. And because of that, the NPVs are different and the IRRs are different. The NPV for the worst case scenario is negative, as is its IRR. But the other two scenarios' returns are positive, and therefore they're feasible. Work out for yourself what the formulae are now that I've been using. You can see I've left the column headers E, F, G, H, I, J, K, and the row numbers 26 to 35 from my spreadsheet are on the screen here, and you can use those as guidelines for how to set up the NPV IRR. Download my Excel file and work along now. The link to the file is in the description below. There are three similar formulas for the evaluation of the cash flow for NPV equals 0, as you can see there. And why do we need to know them? Well, they give us the exact value, the NPVs, at the point at which we find the IRR. It's another way of showing the same thing. And now we start to evaluate the sensitivity results from the work we've done. And what we see here are the base case values and the respective scenario values, and the sensitivity aspect is that we say this. For the expected or base case, there can be no change in the WACC and no change in the cash flows. From then on, just about everything's changed from one scenario to another, and so we can easily find that for the worst case, its WACC increased by 20% over the expected WACC, and its NPV fell by 70% relative to the expected case. The WACC for the best case increased by 50% over the expected case, and yet its NPV changed positively by 70% because, unlike the worst case scenario, where its cash flow fell to 6,000, its cash flow increased by 14,000 to 34,000. What we see here are on the left the data tables, and they are data tables. Look in my file and see how to create those data tables. They're not just tables of data, and they show the NPV profiles for each of the scenarios. And on the right-hand side, I've created the charts or graphs from the data table to illustrate the NPV equals 0, in other words, where we find the IRR from the data table and on those graphs there. Well, there you are, sensitivity analysis with me, Duncan Williamson, between the sheets, excellence since 2000. See you in the next one. Thank you very much for